Welcome back to Silver&Metal IQ, the channel where we cut through the noise and break down what's really happening in gold and silver markets around the world. If you want facts, structure, and signals that matter, not hype, you're in the right place. Today's video is not just another price update. What we're witnessing right now is historic. Silver and gold are making moves that don't happen in normal market cycles. And the big question everyone is asking is simple but critical. Is this just a spike, or are we entering a completely new phase? Stay with me, because by the end of this breakdown, you'll understand why the rules are changing, and why the world of silver may never look the same again. Let's be clear from the start, these price moves are not random, they're not emotional reactions, and they're not driven by retail speculation alone. We are watching a structural shift in how silver is priced, sourced, and valued globally. When one of the world's largest banks even mentions the possibility of $39 silver in 2026, that alone tells you something fundamental is changing. Big institutions don't casually put those numbers out unless the data behind the scenes supports the conversation. And that's exactly what we're seeing now. Data from China, from vault inventories, from futures markets, and from the physical supply chain itself. Let's begin where the signal is loudest right now. China. The Shanghai Gold Exchange has become one of the most important pricing centers in the world for physical silver, and what's happening there should have every serious silver watcher paying attention. Spot silver in China recently traded near $87 per ounce, a level that completely reframes how we should interpret Western paper prices. But even more important than the headline price is the structure beneath it. China is now officially in backwardation, meaning the spot price is higher than futures prices. That is rare, and when it happens, it signals urgency. It tells us that buyers are willing to pay more now because they are worried about getting silver later. Backwardation is not normal behavior in a healthy, well-supplied market. In normal conditions, futures trade at a premium because delivery in the future carries uncertainty. But when spot prices rise above futures, it tells us the physical metal itself is becoming scarce. It tells us confidence in future availability is weakening. And when that happens in a market like silver, which is both a monetary asset and an essential industrial metal, the implications are massive. Now add another layer to this story: vault withdrawals. Recent data shows significant drawdowns from both the Shanghai Futures Exchange and the Shanghai Gold Exchange. Tens of thousands of kilograms of silver leaving vaults in a short period of time. This is not paper trading. This is real metal moving out of storage and into the hands of end users. That tells us demand is not theoretical. It's physical, immediate, and urgent. Here's something else most people miss. Nearly everyone who owns silver right now is already in profit. That matters more than you think. When markets are full of investors who bought at higher prices, rallies often stall because people are desperate to sell and get their money back. But when almost no one is underwater, overhead resistance disappears. There's no wall of sellers waiting to exit. That's why markets making new highs often continue making new highs. The psychology changes completely. At the same time, paper markets are fighting back hard. Futures trading volume has exploded, with hundreds of millions of paper ounces traded in a single day, almost equal to annual global mine production. That alone tells you something is wrong. No real commodity can trade that much supply in a day without distortion. It's confirmation that paper silver is being used aggressively to suppress price discovery. But even that pressure is starting to fail. This brings us to the core theme of today's video. We are entering a new paradigm for precious metals. Physical demand is asserting itself. China is setting the tone. Vaults are draining. Paper markets are losing control. And this is only the beginning of the story. In the next part, we're going to hear directly from a Chinese silver distributor, someone inside the supply chain, explaining why physical premiums are rising even when paper prices fall. That's where things get very interesting. Now, let's go deeper and hear from someone actually inside the Chinese silver supply chain, a distributor who witnesses firsthand how the market operates beyond the screens and charts. His insights are critical because they show what's really happening on the ground, not just in trading terminals. He described a phenomenon that has never happened before. When Chicago raised margins on silver futures, the paper price briefly pulled back. Traders thought this was a chance to buy the dip. But when he checked physical silver, the premiums had already skyrocketed. Silver bars and coins that theoretically should have followed the paper price were now selling for $12, $13 above the official rates. This is where the story gets revealing. It shows that paper silver, contracts, bets, and promises no longer aligns with what it costs to acquire real metal. The supply chain, from miners to refiners to wholesalers, is facing genuine bottlenecks, and the market is responding in real time with higher premiums. He broke the supply chain down like falling dominoes. First, mining factories discovered their production capacity was fully booked months in advance. Second, refiners and large wholesalers realized they couldn't secure enough metal to fulfill orders. Third, silver bar sellers and coin distributors had to reprice inventory aggressively because raw material costs had spiked. Every step of the chain pushed costs upward, ultimately passing the premium to ordinary buyers. In short, scarcity at the source is driving a structural increase in prices. This is not speculative hype. It's real, physical tightness reflected in the market. The takeaway here is crucial. When physical premiums start to decouple from paper prices, the signal is loud and clear. It means the supply chain cannot deliver silver at the price reflected on COMEX or LBMA screens. The contracts we see online are essentially paper promises, while real-world metal commands a higher price. This gap between paper and physical silver is growing, and the longer it persists, the more it reshapes price discovery globally. Now let's bring it back to the West. Western paper prices might read around $80, $81, but Chinese spot silver is trading closer to $87. That's nearly a $6, $7 spread in real terms, an enormous difference that cannot last indefinitely. Arbitrage should theoretically close this gap, but as we saw in Part 1, multiple factors prevent this: capital controls, shipping constraints, vault limitations, and even logistical hurdles like insurance and financing. Simply put, physical metal is scarce where it matters, and paper markets can't fix that. India also enters the picture here. With a population exceeding 1.5 billion and growing industrial demand, silver imports are surging. Indian consumers and investors have a long cultural affinity for precious metals. This adds another layer of structural demand that reinforces China's influence on global prices. The combined effect is clear. We're seeing real, persistent demand from multiple major physical markets, while paper markets struggle to maintain the illusion of abundance. In short, the world is entering a new era for silver. Paper trading, margin moves, and speculative bets can create short-term volatility, but the real driver now is physical scarcity and industrial demand. The next key point to watch is the Shanghai premium. As long as Chinese spot remains higher than Western paper prices, the trend is unlikely to reverse. Supply constraints, backwardation, and strong industrial demand are setting the stage for potentially historic moves in silver, and this is just the beginning. We explored how China and India are driving structural demand, how physical silver is diverging from paper markets, and why supply bottlenecks are creating unprecedented premiums. Now, let's zoom out and look at the bigger picture: industrial demand. This is where silver's dual identity as both money and industrial metal becomes explosive. Understanding this is critical if you want to grasp why prices can continue to surge even when paper markets try to suppress them. Silver is not just a shiny store of value, it's a cornerstone of modern technology. Think photovoltaics. Solar panels rely on silver for efficient electricity conduction. The global solar build-out is massive and accelerating, especially in Asia. Every new gigawatt of solar energy installed requires tons of silver. Then, there's the electronics sector. Semiconductors, 5G infrastructure, data centers, all need silver for soldering, conductive traces, and circuits. Demand here is structural, predictable, and non-negotiable. Factories won't halt production because paper prices dip. They must secure physical silver, even if premiums spike. But that's just the beginning. Electrical applications, automotive components, and industrial machinery all depend on silver. In the EV revolution, silver is critical for batteries and charging infrastructure. Each EV on the road represents a small but growing silver demand footprint. When scaled across millions of vehicles, this adds a tangible upward pressure to physical demand. And remember, these are global trends, not short-term speculative trades. Jewelry and coins are the other side of the equation. Historically, jewelry absorbs significant amounts of silver, and today we're seeing renewed interest in high-quality silver pieces. Rising wealth in emerging economies is fueling demand for both investment-grade coins and jewelry. Coin and bar demand remains strong as private investors continue to hedge against currency debasement and financial uncertainty. When all these sectors overlap, industrial, monetary, and jewelry demand, we get a perfect storm of silver consumption against a relatively inelastic supply. And speaking of supply, the numbers tell a stark story. Mining production has plateaued or even declined in some regions over the past decade. New projects take years, sometimes a decade, to reach meaningful output. Recycling can help, but it's costly, energy-intensive, and limited by available scrap. So, as demand continues to rise across photovoltaics, electronics, EVs, jewelry, and coins, the supply side cannot scale fast enough. This structural mismatch is why physical premiums are decoupling from paper prices. Now, let's touch on a sleeper trend: tokenized silver. Just like gold, silver is being incorporated into blockchain-based, fully backed tokens. This opens a new category of demand: investors who want exposure to real, deliverable silver, but through digital platforms. While still nascent, this trend has the potential to absorb large quantities of physical silver without it ever touching traditional retail channels. It's a silent but powerful additional demand driver that many traders aren't yet factoring in. So, to summarize, industrial demand is relentless and growing. Jewelry and coins maintain traditional pressure, and new technological and financial applications, like tokenized silver, are emerging as game changers. Meanwhile, mining and recycling cannot keep pace. The result? Structural scarcity that reinforces rising prices and persistent physical premiums. This is why paper markets, margin adjustments, or speculative pullbacks can only temporarily influence price, while the long-term physical trend remains bullish. The physical silver market is sending signals that paper prices cannot fully reflect. Backwardation in China, widening premiums, and tight inventories all indicate that structural scarcity is becoming the dominant factor in price discovery. While COMEX or futures contracts may fluctuate, these are often just reflections of short-term sentiment or speculative flows. The real story is in the physical market, where factories, refineries, and distributors are struggling to source silver at any reasonable price. This pressure is compounded by supply chain bottlenecks, logistics challenges, and rising replacement costs. The result is a market where the physical price is increasingly disconnected from the paper price, a divergence that will dictate the next phase of the bull run. Industrial demand continues to outpace supply, particularly in renewable energy and electronics. Solar panel production alone consumes hundreds of millions of ounces annually, and this demand is accelerating as countries invest heavily in clean energy infrastructure. Meanwhile, the EV sector is rapidly expanding, requiring silver for batteries, wiring, and charging systems. Data centers, 5G networks, and semiconductors also depend on silver, and there is no substitute that matches its conductivity and reliability. These sectors cannot pause or wait for lower prices. They must secure metal, even at a premium. That is why we see persistent pressure on physical silver, even when futures contracts temporarily pull back. Jewelry and coin demand are also significant and often underestimated. Rising wealth in countries like India and China drives investment in physical silver, both as a hedge against inflation and for cultural and gifting purposes. Coins and bars remain the preferred form for private investors, further tightening the market. When you combine industrial, monetary, and retail demand, the total global requirement consistently outpaces annual mining output, creating a deficit that is structural, not cyclical. Another emerging factor is tokenized silver. Digital tokens fully backed by real silver stored in secure vaults are creating new demand channels. Investors who may not buy physical bars or coins can now gain exposure through blockchain-based platforms. While still small, this trend could scale quickly, further reducing the available physical supply and strengthening premiums. This is a silent demand driver that many market participants have not yet accounted for, but its effect could become substantial in the next few years. Geopolitics and macroeconomic forces amplify these structural pressures. Central banks continue to debase currencies through quantitative easing, lowering real interest rates and creating an environment where tangible assets like silver are increasingly attractive. Trade tensions, sanctions, and strategic stockpiling by nations add another layer of scarcity, as silver is treated not only as a financial asset, but as a strategic industrial material. The convergence of these factors, structural supply deficits, rising industrial demand, retail and monetary demand, and macroeconomic pressures, sets the stage for significant price volatility and continued upward repricing of physical silver. In short, the market is evolving into a regime where physical reality drives the narrative, not paper contracts. Premiums that diverge from COMEX or LBMA prices are no longer anomalies. They are the natural outcome of tight inventories and relentless global demand. As more investors and industrial players recognize this dynamic, the gap between paper and physical prices is likely to persist, reinforcing the upward trend in tangible silver markets. The next moves in price will not be smooth. They will be punctuated by sharp adjustments, forced buying, and widening spreads. As the silver market continues to evolve, understanding the signals behind price action is critical. The first key indicator is the Shanghai Premium, the difference between the price of physical silver in China and Western exchanges like COMEX. When the Shanghai spot trades significantly higher, sometimes $8 to $10 above COMEX, it signals that physical demand in the East is outstripping supply. This is not speculation. It's hard data reflecting factories, refineries, and distributors willing to pay more to secure silver immediately. Such premiums often lead the paper market, meaning COMEX prices eventually catch up. Watching the width and direction of this spread gives insight into whether we are in a temporary spike or a sustained repricing phase. The second signal is the two-price system, seen in premiums on coins, bars, and retail physical products. When COMEX shows $81, but coins or bars cost $87, $90, it's a clear indication that replacement costs are rising. Dealers cannot source enough metal at the official price, and they pass the cost on to buyers. Long delivery times, low inventory, and limited purchase allowances further confirm that supply is constrained. Observing these conditions across multiple retail and wholesale channels provides a real-time map of where physical scarcity is most acute. These signals also hint at potential forced buying, as industrial users, miners, and hedgers are compelled to act at prevailing prices to meet contractual obligations. The third key indicator is volatility paired with forced flows. In a stressed market, large daily price moves, 5%, 6%, even 7%, are not purely speculative. They often reflect mechanical buying from shorts covering positions, industrial users securing essential metal, and trend-following algorithms responding to upward momentum. This creates a feedback loop. Rising prices trigger more forced buying, which drives prices higher, further widening spreads between physical and paper markets. Recognizing when this loop is active allows investors to differentiate between a temporary market spike and a structural repricing event. Additionally, global demand trends provide context. China and India remain dominant physical buyers, with their industrial, jewelry, and investment demand continuing to rise. Renewable energy initiatives, EV production, electronics, and solar panel manufacturing all create structural demand that cannot pause for lower prices. The limited ability of silver mining to increase output quickly, due to long project development cycles and declining ore grades, ensures that supply-side relief is minimal. Even recycling, while helpful, is insufficient to bridge the gap between growing demand and constrained supply. Macro and geopolitical factors further reinforce these dynamics. Currency debasement, low real interest rates, and central bank interventions increase the appeal of tangible assets. Simultaneously, nations are increasingly stockpiling strategic commodities, including silver, to protect industrial and technological sovereignty. These forces amplify market scarcity, making traditional paper benchmarks less meaningful compared to physical market realities. For investors, understanding these three key metrics, Shanghai premiums, two-price spreads, and volatility-driven forced flows, is more important than chasing price targets. They provide a roadmap of structural pressure points in the silver market, revealing where and when repricing is likely to occur. The combination of constrained supply, rising global demand, and mechanical buying pressure suggests that silver's upward trajectory is far from over. Those who track these indicators are better positioned to anticipate market moves and understand the underlying forces shaping prices, rather than reacting to headlines or short-term fluctuations. As we wrap up our deep dive into silver and precious metals markets, it's critical to take a step back and connect all the dots. What we've observed in China, India, and the Western markets is not just volatility, it's a structural paradigm shift. Physical silver demand is surging, supply is constrained, and mechanical buying pressures from industrial users, hedgers, and trend-following funds are creating a feedback loop that pushes prices higher, often faster than conventional paper markets can keep up. The Shanghai premium, widening physical spreads, and persistent backwardation are not anomalies. They are the symptoms of a global market rebalancing, where the East increasingly sets the price and the West follows. This has profound implications for anyone tracking silver. The conventional view that COMEX prices represent the real silver price is no longer fully accurate. The physical market now dictates the true cost of acquiring metal, and paper prices often lag, sometimes by $8, $10 or more. Observing the mechanics of forced buying, inventory shortages, and supply chain constraints allows us to anticipate how and when the paper market may catch up. When industrial and monetary demand collide simultaneously, as is happening with renewables, electronics, jewelry, and tokenized silver initiatives, we are in a structural bull market, not a temporary spike. India and China remain central to this narrative. Both nations have massive populations, growing industrial bases, and strategic initiatives that require silver in quantities that exceed historical norms. In China, backwardation in the futures market shows buyers are willing to pay more now rather than risk higher prices later, while vault withdrawals indicate real scarcity. In India, the cultural preference for silver jewelry and bullion, combined with a growing consumer class, ensures that demand will continue to accelerate. Global supply cannot be ramped up quickly to meet these pressures, making deficits the new normal. We also need to account for macro factors. Currency debasement, geopolitical uncertainty, and central bank policies are encouraging both monetary and industrial buyers to secure tangible assets. Silver, which straddles both worlds, is uniquely positioned to benefit. Unlike paper markets that can be influenced by speculation or short-term sentiment, physical silver reacts to real-world needs, making it resilient to temporary shocks in financial markets. Recognizing the interplay between these forces, supply constraints, rising demand, forced buying, and macro pressures, is essential for understanding why the market is behaving as it is. Now, let's consolidate this into 3 actionable insights. First, track the Shanghai premium and other physical market spreads. They are the clearest indicators of supply stress. Second, monitor inventory, delivery times, and premiums on coins and bars. These show the real availability of metal. Third, watch for volatility and mechanical buying events, which often signal structural repricing rather than temporary market fluctuations. These metrics, when combined, provide a framework to anticipate market movements without relying on speculation or guessing. Finally, a financial disclaimer. The insights shared here are for educational and informational purposes only. This is not financial advice, and nothing presented should be construed as a recommendation to buy or sell any assets. Always conduct your own research and consult qualified professionals before making investment decisions. Precious metals markets are volatile, and individual circumstances vary widely. Decisions should be made responsibly and with awareness of risk, leverage, and exposure. In conclusion, the global silver market is undergoing a historic shift. Physical demand, constrained supply, and macroeconomic factors are converging to create a new pricing regime. COMEX prices will continue to follow physical realities. Shanghai and India will set the tone, and investors who understand these structural dynamics will be better positioned to navigate the opportunities and challenges ahead. The era of passive observation is over. Active awareness of market mechanics is now essential.